Greetings. Today is Friday, May 31st, 2024, and today is Savannah's birthday. So our oldest child just turned 19, so a big happy birthday to Savannah. That said, we're going to take a look at a couple of things. A big key test in the S&P 500 today, the last trading day of the month. And I'll go into a lot more detail next week when I shoot the monthly market monologue. But on the screen right now, we have the monthly candle chart for the S&P 500. So this last candle right here represents the month of May, and it's a pretty nice candle. We see a little bit of a sell-off here, but for the most part, it's been a pretty positive month for May. That said, let's look at the daily candle chart. This is now the daily candle chart for SPY, and one of the many S&P 500 ETFs that mirrors the S&P 500. And you can see that this black candle right here is the current trading session, and the market is indeed selling off a little bit right now. The green line represents the highs from April. So this is the key test that I'm talking about. Yesterday, unfortunately, the S&P 500 closed below that level, and today it looks like it is struggling to regain that. I, for one, would love to see a little bit of strength in the afternoon session to get us back above that level. But so far, it looks like we might very well close below those April highs. Not entirely good news, but nothing to be alarmed with. One of the things we've talked about many times is within a bull market, we're going to have corrections. The stock market never moves up in a straight line for very long. So that said, one of the things that we like to look at is the Atlanta Federal Reserve's GDPNow tool, and their latest forecast is on the screen right now. Full disclosure, they are releasing an update later today. I keep hitting the refresh button, but I need to shoot this video, so the latest hasn't come out. It will come out later today. But as of right now, Atlanta Federal Reserve is forecasting second quarter GDP will come in at about 3.5%. That is their current forecast. This green line is that forecast, so you can see how that has acted. If that is true, this is what we would see on the GDP histogram. That red bar would represent approximately 3.5% GDP. So as the economy has come in a little bit, if the Atlanta Federal Reserve is accurate, then we get a little bit more growth. So that is certainly good news. That said, one of the things I was chatting about with somebody recently is their 401k and how aggressive they should be in that 401k. And one of the things we talked about is bonds and the fact that bonds are still struggling. On the screen right now, I have the chart for the iShares 20-year bond ETF, TLT. And I've got a different set of indicators on this. Big thanks to the CMT Association and Tyler Wood and I think is Alex Cole, the creator of this NoGo system. And I was able to get this into my charting software. And right now, bonds are still a no-go. Long-term bonds in particular, are still struggling to break through that long-term downtrend line. And so it begs the question of how much bonds you should really be having in your portfolio. And for a lot of people, their 401k is a large portion of their nest egg. And what we have seen over the last 25 years of me being in this business is most people set up their 401k and they leave it alone. That is certainly not what we would recommend. And so if you have questions about that, by all means, feel free to reach out. You can find our contact information at Hicks-Associates.com. Be happy to chat with you about how we might be of service in that regard. But the point is, historically speaking, bonds have been used as a portfolio stabilizer because they have historically had less volatility than equities. That has not been the case as of late. And so if bonds continue to be in a downtrend, should we really be relying on them as a portfolio stabilizer? One thing that we might consider is using a different mechanism to manage volatility. And we've talked in some of our videos about the VSI indicator that we created, that we use in some of our decision making in terms of how we're allocating our client portfolios. And so the one simple strategy would be to use equities when these types of indicators are on a green light. And when we're on a yellow light or a red light, you either do something different, you go to cash, or Anyway, that's something for you to consider, is maybe we don't want to rely so much on bonds to be a portfolio stabilizer when bonds have been in a downtrend and they are struggling to get out of it. So anyway, that's enough for today. I hope you'll tune back in next time. If you haven't already, we certainly would love it if you check out our new website. Hicks-Associates.com is still the URL, but we've refreshed the design. And for those that are not familiar with us in general, I would tell you that our professional asset management uses a multi-strategy approach, and our risk-based philosophy means that we are trying to minimize drawdowns while we are capturing upside momentum. If you have any questions on how we might be of service to you, by all means, feel free to reach out to us. You can click one of the blue buttons on our website. And in the meantime, we thanks for watching. Again, hope you will hit that subscribe button. Make sure you watch next week's video where we'll dive into a lot more depth. Till then, have a good weekend.